Happy Monday, everybody. Welcome. Good to be with you on the call. Those of you on the Zoom with us tonight, good to be with you. Those of you who are chiming in from YouTube, good to be with you wherever you are in the country. Let's go. Happy Monday, man. It's November 18th. Thanksgiving's coming up, guys, pretty soon. Man, are you being kind to yourself this year? Are you being kind to yourself this year? And what do I mean by that? It means, are you actually crushing it in business this year? Are you going out here and doing exactly what you said you would do in terms of revenue, profitability, success, outcomes? Guys, if you are not giving yourself that gift, I invite you to give yourself that gift no matter what it takes. Go out here and crush it in what you're doing, especially in the trucking industry, man. Go after it is what I want to say. All right, so that you can give yourselves a great gift. The holiday season is coming up, and these markets are funny during this time of year. Hopefully you're well positioned to take advantage of the situation, this holiday season. And in this conversation today, hopefully we'll set you up with some great decisions you can make with your cash flow to ensure that you win when it comes to keeping your hard-earned money in your pocket. All right, so guys, let's go, man. I want to get into this call with you. And if you're brand new, just put in the chat, man. Brand new. Let me know where you're from. We'll reach out to you guys and make sure you're acknowledged. All right. Hopefully, we can acknowledge you on the call. But if not, man, I will. I'll get to you to acknowledge you. Okay. So welcome, and let's get going. Okay. In case you didn't know, this is me, Cheston Bulgin, with Buy the Books Consulting. I'm the founder and CFO here. I'm trucking CFO, tax strategist, also known as your accounting superhero. You can reach us at 888-4BTB now, 888-428-2669, or on the web at youraccountingsuperhero.com. You can also reach me at cbulgin at youraccountingsuperhero.com. That's my email. And follow me, guys. Follow me on Instagram. If you haven't followed me on Instagram yet, you want to do so, because I'll take a little snippet from this and I'll make a couple of cuts from it. But more so than that, I'm speaking to things that you can do directly, to improve your cash flow, to keep more money in your pocket, to improve your performance in your trucking company. So whatever I get over here where I am, because I am working with a lot of people, but not in the trucking industry. I'm working with a lot of people in the trucking industry, and also, I've been in the trucking industry, so I actually know a lot about what you go through. So I've been a driver for a major fleet. I've been a trainer for a major fleet. I've been an owner operator with a major fleet. I've owned my own fleet of trucks. I have my own authority. So I do get a lot of what you go through. So when I do share, it's going to be sharing from the position that I want you to win. And in order for you to see and get access to that, make sure you follow me on Instagram. Okay. We post content on there regularly, is what I want to say. All right. Now, we specialize in the accounting aspect of what you do, QuickBooks Online, and the tax strategy, the tax planning, the fleet advisory, business advisory, the technology that you use to run your business, the systems that you get to create in your business. It's what we specialize in. Okay. And if you have not yet joined this group, the Truck Profit Academy, run out of time. You're running out of time to join this at no cost. At the end of the year, it will no longer be free. Okay. So you want to take advantage of this opportunity right now to be a part of the Truck Profit Academy. You can go there and join the Truck Profit Academy, going to truckprofitacademy.com and signing up there. Also, you can still take advantage of a free profit and cash flow analysis with me directly or somebody on our team. All right. So you can stop wasting time and increase profits and cash flow as soon as today. And you can do that by going to youraccountingsuperhero.com/book-and-appointment. All right. And quick disclaimer before you get started, the following is for educational purposes only and is not to be considered financial, accounting, or legal advice. Please consult your tax, accounting, and/or legal professional for specific advice. Okay. Now that that's done, okay, it's good to be with everybody on the call. I've had this conversation with more than one person, and I realize that this is a gap in understanding. And I want to bring this to the understanding of each and every person who's listening and chiming in, because, you want to pay your bills. You want to have your personal expenses taken care of. You want to understand what it looks like to pay yourself from your business. And you want to do it in the right way. You want to make sure that when you do it, that you're not overexposed to taxes either. Um, and you want to have peace of mind around it, really, right? If that makes sense to you, and go ahead and put a one in the chat if that makes sense to you. If that's you, where you want to be able to do these things, you want to do it in a way where you have peace of mind. Just let me know if that's you. Put a one in the chat if that's you. Whether you're on YouTube or you're here in the call with us, just let me know, okay? Because I got to know I'm speaking to the right people. Okay, that's what I got to know. I'm speaking to the right people today. So when I say that, what I've seen in the past and what I've seen even recently is, people will go and, number one, either sometimes they're not on payroll. You don't have to be, depending on your structure. And, if you're a sole proprietor, for example, you don't have to be on payroll. You can take all the money inside of your business is yours. It's just that, if you're doing well, if you're profitable, you're spending more in taxes than necessary. That's just most likely the case. Okay. And you want to get with somebody to review that and make sure that that's the case. But if you're not set up with an S corp structure right now and you are making right around $40,000 or more, then you're overspending in taxes. Right? You're overspending in taxes and it's unnecessary. Okay. So when I'm speaking about people that are paying themselves for the business today, I really am speaking to those of you who have set yourselves up as an S corp or that are thinking about setting yourselves up as an S corp and how to manage that appropriately. And thank you, sir. I see you chiming in with the one in the chat. Appreciate it. And it can be confusing. And we want things to be simple, and we want to do things at our convenience a lot of times as well. What do I mean? I want to be able to take money out of my business to pay my personal expenses, and I want to do it in a way where I'm not going to get in any trouble, and I'm not going to have any backlash from it. So what are the ways that we do this? Number one, we do this when we pay ourselves through payroll. If you're an S corp or thinking about being an S corp, so you do this when you pay yourself through payroll, and you also do this when you take what we call a distribution. Now, the cool thing is that the S corp will limit your exposure to self-employment tax. We talked about that before in earlier sessions, and you can go back to our history of videos if you have not seen that yet. So it reduces your exposure to self-employment tax, which is fantastic. And that's really if you're paying yourself compliantly, which is through a wage. You pay yourself a W-2 wage, and that W-2 wage is the limitation of what you would be exposed to when it comes to self-employment taxes. Whereas if you were in a business that did not have this structure, the entire profit of the business would be subjected to that self-employment tax. Big deal. Okay. Now, no, number one, like I said, you're paying yourself a wage through an S corp. That's number one, how to take money out of your business. But then I have people ask me questions. Well, Cheston, I need to pay myself more in a wage, right? I need to pay myself more because I have, personal expenses that I need to take care of. It's not enough for me to just pay myself $40,000 a year or $50,000 a year. I need to pay myself more because my expenses, personally, my budget personally is like $80,000 a year. It's $100,000 a year. And my business is generating like $200,000 of profit. So why not? Why can't I just pay myself more in wages? You can pay yourself more in wages. And there's a consequence to that, all right, called, you're paying more in self-employment tax. Anything that you pay yourself in a paycheck is subject to what we call self-employment tax. That's a 15.3% additional tax that you would pay yourself that's above and beyond like federal income tax, ordinary income tax, okay? And if you've seen your paycheck, if you've ever been an employee and you've seen your paycheck, you'll see Social Security and Medicare. That's that portion that you see that's deducted from your paycheck, and we call that FICA. And the employer would typically pay the other half of what you pay. So in a paycheck, typically you just see half of what you would pay into that FICA tax, and the employer pays the other side of that. But if you're the employer of your company and you're paying yourself a paycheck, you get both sides of that, right? So 7.65% on one side, 7.65% on the other side, giving you 15.3% of self-employment tax, okay? Now, if you're going to pay yourself more money, you're going to, in a wage, like a W-2 wage, or you're going to pay yourself more money in a W-2 wage, you're going to increase the amount that you're spending in that tax, which is why we want to limit that accordingly. We want to pay yourself a reasonable compensation, but we don't want to pay yourself extraordinarily high in that amount. We don't want to be excessive in the amount that you pay yourself, is what I want to say. All right, because if you're excessive, then you're going to end up paying more in taxes than you need to. But well, how do we handle that other difference that you need for personal expenses if you don't have that much in wages? And that's one of the things that I hear from people. They have questions around that. And the other side of that is distributions. Okay, and we take a distribution from the business to supplement the rest of the income, whatever else you need. You want to understand how much that is for your budget. And then we're going to talk about what you really need to understand to make sure that you're not getting in trouble when it comes to distributions. When I say getting in trouble, just having extra taxes that you would pay because you're taking too much out of your business. All right. So it's a pretty cool concept to really understand, because you can really master your cash flow and understand how to budget accordingly and keep yourself out of trouble and have that peace of mind that you're seeking from this. Okay. Now, so let's talk about this. I want you guys to understand distributions. I want us to all understand what distributions are. So what are distributions? Okay, so let's look at it like this. When your business makes money, like at the end of the day, it's profitable. That profitability is what is taxable for you in that current year. The profits are taxable in the current year. So let's say you bring in $2 million in revenue, and then you have all your expenses, and then left over, you have $200,000 in profit. Well, that profit of $200,000 is what's taxable to you on the individual level. Okay, it's not taxed at the company level with an S corp or any of the other types of pass-through entities. Okay, and we'll talk about pass-through entities at another time, but it's taxed to you on the individual level. That's what you're liable for when it comes to income tax, is the profits for that business. Okay, that $200,000 in this case. Now, no matter what, that's going to be the case. Whether you leave that in the business or you don't, it's still going to be taxable to you. Okay. Now, of that, you and I are able to take out money to run our lives because we made that money. It's our money. So we can take money from that, and the money that you take out of that 200,000 of profit, like you extract maybe, let's say, $50,000, $60,000 from that 200,000. Well, that's not really taxable. That's what you call a distribution. It's already been taxed at the profitability level, the profit level. When you take money from those profits, it's not taxable. We call that distribution. Okay. Now, it's a pretty cool concept to understand, because if you realize the power of owning your own business, this is why people get to own their own businesses, is because there's a mastery of cash flow and there's a mastery of taxes if we so choose to master these things inside a business. What do I mean? I mean, if you are just a W-2 employee, you get taxed before you even see the money, right? You get taxed before you even see the money. Now, as a business owner, you get taxed on what's left over, which is the profits. And then you have this cool thing over here called distributions, to which is not taxed at all, right? The money that you extract from those profits. Different ball game altogether, not something that you can do as an employee. And it really makes sense to master this as an entrepreneur, as a business owner, okay? And understand this to, number one, ensure that you're able to have enough money to cover your budget at home, right? Cover all your personal finances and grow wealth in all these other areas personally. And also understand what you can do to be on the right side of the tracks. And when I say the right side of the tracks, it means that there's peace of mind. There's nobody coming after you because you have done something wrong. Okay. To understand how that works, and usually it comes in the form of just paying extra taxes, is what that looks like. Okay. And you can actually stay on this side, the right side of the tracks, and have your life work financially because you really understand this to a large degree. Okay. So distributions, not taxable. Profits, taxable. Distributions, not taxable. And you see this here. It says, unless taken in excess of basis. Unless taken in excess of basis. All right. You're like, man, Cheston, what is that? What does that mean? Okay. Well, I had a conversation the other day with a client. He was wondering, two things. Where's all this money? in his business because he's profitable. He's crushing it this year, right? He's doing, um, profit wise, he's doing more than double what he did last year in profits, and his bank account is lower, even though he's making more in profits. Well, how does that happen? Well, it goes when these things like distributions, they go unchecked. Okay. Like you're just taking money out of the business and it goes unchecked. You're not really present to the impact of taking money out of the business. So his situation was he's wondering, number one, why is his cash balance so low in his business? And then number two, he's going to be dealing with something later on because he had some loans, right? He did have some loans, right? And now he's going to end up pulling out more money than what he has in his business, profitability wise and equity wise. And if you do that, there are tax consequences, right? Sounds great, right? Sounds great. There are tax consequences for that. Yeah, guys. Every time we do something in this country, we want to understand the like financially, like with business and finances, we want to understand the implications tax wise, so that we can play the game at a high level. We understand the rules of the games. We can just be in the framework of the rules. But then there's a whole lot we can do once we understand the framework of the rules. So one of the rules that we have to understand is that you can't take out more money from your business than you have in your business, unless you want to pay extra taxes. Comes in the form of capital gains. This is the big deal. We get capital gains tax when we do this. All right. And we want to make sure that for yourself exactly how this operates. Okay. So let's actually talk about it a little bit. Okay. And just bear with me, guys. I want to share something with you. And I want to make sure this makes sense and this lands. Now, if this is starting to make sense to you, if this is like, actually put a 2 in the chat if this is completely confusing. Okay. Put a 2 in the chat if this is completely confusing. Put a 3 in the chat if this is really starting to make some sense to you. Okay. I want to check in to see where you are, like with this. Okay. Let's just check in. Yeah, put a 2 in the chat if this is absolutely confusing. Thank you. Got a number 3 in the chat. Thank you. Yeah, it's starting to make some sense, right? And I want to, make sure that if you do have any confusion around this, guys, you can always put in here like questions. And if I don't get to them during the call today, I definitely will get to them at some point, like throughout the week, so that it just becomes clear. Okay. Here's what I want to share with you, though. Okay. Let's check this out. I'm going to share my screen. Okay. Awesome. Got some 3s in the chat. Fantastic. So we just talked about this, and I want to make sure we get some visualization to this to understand what this is. So this is what we're just talking about. You guys can see my screen okay, right? All right, you should be able to see profits, taxable, investments, and the combination of these two make up what we call equity. Another terminology for this, guys, by the way, equity, we can kind of interchange this terminology, basis. So when I talk about distributions in excess of basis, it simply means that I'm taking out distributions more so than I have in the business personally. So I'm taking more money out of the business than I have in the business. And how is that even possible to do? Usually it comes about because we have loans. We're going to look at that in a second, okay, to understand what the impact is. All right. So we talked about this. On the left-hand side, we see profits. These are taxable. This is what we just talked about. So you go and you make money in your business. At the end of the day, the money that you make net profit-wise is the taxable amount that you handle on the individual level, like personal level, you handle that. All right. And then that money that you make profits, it gets rolled into how much you have in the business. It's like your equity in the company. It actually increases. That's what that plus is here. It increases your equity in the business when you have profits. Like I said, like if you went and you generated $2 million in revenue, but at the end of the day, you had $200,000 in profits, that'd be $200,000 extra equity that you would have in the business now. All right. That's how that works. Now, the other side of that is investment. So if you put money into it, let's say that you had personal assets or personal cash that you put into the business that also serves to increase your equity or basis in the company. Okay. All right. So these are the two main things that impact your basis. Now, what happens if you're not profitable? Instead, you are unprofitable and you take a loss. Well, it has a converse effect on your equity. So if you lose money, it takes away the amount of money that you have in the business, the amount of equity that you have in the business. So if you go out here and you lose $200,000, it erases that $200,000 that you made profits in equity. Okay. So those are the things that we want to be mindful of, because those are the things that directly impact your ability to pay yourself in distributions, which is here on the other side. Okay. The distributions, see a little minus here. So distributions impact your equity and basis negatively. When you take money out of the business, well, you have less equity in the business when you take it out personally. Now, some of you, and like most of us anyway, and pretty much all of you really want to do this, because this is why you have the business in the first place, is to go and take that money that you're making and use that for you personally. Okay. And the ways that we extract that, like we said, wages, distribution. The thing about like S corp structures is that it allows you to do this in a way where you're just like the profits, they're subjected to just ordinary income tax, and they're not subject to self-employment tax, the net profit of that business, which is cool. And then distribution wise, those are not taxable as long as you're not taking out more so than what you have in the business. So what would you do here, right? Because the thing that I remember, I was just talking about one of the people I was speaking with earlier last week, and they were just not really present to this. Okay. And a lot of people aren't present to this. They're not aware that when they take money out of the business, how it impacts like taxes and everything else, and what they're really taxed on. And we're just thinking about, okay, I just need this money right now. That's all we're thinking about. And we're not really forward thinking about it. We're not proactively thinking about it. We just react and do what we need to do in order to live our lives. Now, if you take this information and understanding, well, you understand the impacts, you have a whole new set of choices that you can make versus somebody who did not have this knowledge base. Okay. And that's what we're here for today, is to make sure that you understand the impacts. You understand how this works so that you can game plan, you can be proactive about this to master your cash flow in this area. Okay. So distributions, when we take money out of the business, and this is a natural course of what we do anyway, just get that it has a negative impact on the amount of equity or basis that you have in the business. Now, the thing about equity is that it builds year after year. It's a cumulative thing. It's not like it just ends this year and that's it and restarts the next year. No, it's a cumulative. So what I do this year actually impacts next year and the year after and the year after. Right? And so on and so on and so on. And it accumulates over the time. So a healthy business wants to grow in equity year after year. And a healthy business grows in equity because it is profitable year after year. And then it's managing the cash flow in such a way where we understand the impacts of what it looks like to take a distribution from the business. And we're not abusing distributions. We're taking those out in moderate levels in order to make sure that the business remains healthy. Okay. That's the intention behind this, is really know how this impacts so that we can do it in a way where the equity in the business can grow year after year after year after year. And why would we want to do that? Because freedom, wealth, and legacy. Freedom, wealth, and legacy. Those are the things that we want to accomplish. If you're in this conversation with me right now, then most likely that's what you're looking for, because you are my people. Like, I only speak to my people, guys. Just get that. I'm only speaking to my people here. And my people want freedom, wealth, and legacy. So if you're somebody in this conversation, that's most likely you. And in order to have freedom, wealth, and legacy, we want to understand how to grow in equity inside of everything that we do. Okay. And especially in business, because you have a direct control over the performance of that to steer that in the direction where you have increased equity in that business year after year after year, so that your business becomes saleable, it becomes attractive to other investors, that it can stay around for decades after you leave this earth, because it's the equity growth is a positive health. It shows a positive health. It shows a healthy business over time. So if we're doing that in a way where we just know, like clockwork, we're going to grow in equity 25% or more. Boom. And say, oh yeah, this year I grew in like 40% equity, so I'm only going to take out maybe 5 to 10% of that in distributions. because I want to make sure that we're above 25%. That's the goal, right? And it may not be the case now, but that could be a destination for you, because it just proves that, okay, you have longevity in your business, it's healthy, it's growing, and it's growing in equity base, so that number one, the distributions you take can always remain non-taxable. And number two, which is more important, you create that freedom, wealth, and legacy in this area of your life. Okay, and it becomes very healthy overall. All right, so let's take a look at this a little bit in detail, all right? And just to give some clarity in this, an example here. Let's say this is your business, okay? And you've invested $250,000 in it. That's at the base of this is $250,000 of your own money that you put into your business. And then your business was profitable last year, $250,000, right? And that's the total that you just really got started and you did well that first year. Well, total equity that you have in the business is $500,000 between the profits and the investments, okay? Now, let's say in the beginning of the year, you actually decide to take out a loan for $250,000. Okay. Well, now, guess what? There's not just there's a formula here. It's called assets equal liabilities and equity. Assets equal liabilities and equity. Okay. So there's $750,000 in equity and loans, which means that somewhere along the line, there's more than that. There's exactly $750,000 rather. There's exactly $750,000 in assets. It could be all cash that you have in your business. It could be a cash combination of cash and equipment that you have in your business. Okay. So assets equal liabilities and equities. And equity. Okay. This is really the formula for a balance sheet, guys. FYI. All right. But if we have $750,000 total in equity and loan, which is a liability, well, that's $750,000 that I would expect to see in assets. Now, what if I just took distributions out? Like I took distributions out of $600,000. Well, technically, I have that much in there between like asset base. I technically have a $750,000 in asset base. So it's possible for me to do that because I have more in asset base from the loan and from the equity, right? So I have $750,000 total in as much assets that are in the business. So yeah, $600,000 is less than that. So that's there for the taking. Okay, it's definitely there for the taking. So if I take $600,000 out of it, I'm like, man, cool. Let me just take my 600 grand. There's, we still have, $150,000 in assets in the company. Fantastic. Right? That's how it could go. That's how we could think. But look, man, well, $100,000 that you took out was not yours to take out. It was not inside of the business in equity to take out of that business. Okay. So if we do that, well, then we're going to suffer the tax consequence. And usually it looks like in the form of capital gains. Okay. Which is either 15% or 20% right now. Capital gains, additional taxes that you would pay on that extra $100,000. Okay. That's the ramification of that. Now, if you did not know that, you'll be blindsided. Correct. Well, distributions will be reported. I have a question that came in. Distributions will be reported in terms of there's a basis worksheet that comes up as a form like that. That's a form that gets reported on your tax return, both on the business side and on the individual side, that shows all of the activity related to distributions and everything. Okay. And the numbers want to make sense, right? Because at the end of the day, like if you're a business that has a bunch of assets in it that gets reported on your tax returns, the math wants to add up to show, okay, well, what happened to all these assets? They had this cash. Where did it go? And they look to reconcile that activity on your business tax return. And that activity that gets reconciled on your business tax return. Basically, what that means is that we file a tax return for the business so that the IRS can see the activity of the business. And in that activity, it shows distributions. Okay. in terms of like what the basis was in that. Okay, so the numbers will make sense, right? We can't escape that. The numbers will never ever lie. Like they have automations in there to actually see what's going on. Like red flags will be raised once they can see, okay, well, what happened to these funds? Oh, the owner took them out, but the owner didn't have this much in there. They just had loans. So they took extra to make up what was taken out in distributions. Okay, well, capital gains, that's what's wanted here. Audit. Okay, audit. So let's go and see like why they're not reporting capital gains on their individual return when they should be. Okay, that's how that would go in that scenario. All right. So the idea here is that you don't want to be blindsided by this. You want to go in here with your eyes wide open and avoid being blindsided come tax time, because that 15.3% could be a beast when you're not expecting it. In this case, with prices and the economy the way that it is, $15,000 is a lot of money. Right? In this example, it's like $15,000 for capital gains on that 100,000 additional in taxes outside of what you were expecting to pay. All right. So get that, man. You don't want to go into that situation, that scenario blindsided. You want to know exactly what you're doing when you're doing it, operate intentionally, and get the outcomes that you seek instead of walking in the dark and just taking random actions and then wondering why your life sucks. Right? Why me, man? Why? Why does it have to always be me to deal with these things? Right? It doesn't have to be you, because you're in this conversation. You actually are in the know now. And what I want you to be left with from this discussion is the fact that you can take cash flow actions. Like, you want to really, if you're not really good with numbers, you want to get with somebody who is understanding in this area. They have an acumen in this area. You can definitely reach out to me if that's the case, to get an understanding of what you've been doing up until now, because it is the end of the year. How is this reconciling, and what can you expect moving forward? Take advantage of that free profit and cash flow analysis to get on a call and say, well, what are we looking like? What do we do here? You may not have been monitoring how much you've been taking out of your business in that way, month after month, or even quarter after quarter, to understand your position right up until now. And if you've taken loans out where you've gotten cash, because I've seen people, they take out loans and their cash amount loans, like business loans, and then all of a sudden their distributions, they go way high, and they weren't profitable, and they took out this money. Especially when it happens like in a scenario where right now it's the end of the year, and then you go out and you're actually spending a lot on expenses outflow, and then something happens where you're not bringing in as much revenue as you thought you would bring in. So it turns upside down. So you're not as profitable. You're actually going into the negative now, and that impacts your equity negatively. And, and if you've taken out, like some people take out these MCAs, these merchant cash advance loans, and they keep paying them back over and over again. Like I'm saying, keep paying them back on a daily basis, or daily pays. So all of that's going on, and you're not really paying attention to the impact. Okay. And it could have not just a strain on the cash flow type impact, but strain on taxes, giving you excess headaches that you're dealing with. It's like frustrating and stressful, and you don't know like how you're going to make ends meet, because it's like, where's my cash at? And then you didn't know that you haven't really managed it in a way where you were setting yourself up to win from a year ago or 2 years ago, right? But when is that going to begin for you? That line in the sand moment should be with you right here, guys. Hold on a second. I'll just stop the share. Yeah. So when is it going to be the case? They're going to make that line in the sand moment, draw that line in the sand, and say, okay, from this day moving forward, I'm going to manage my business financial affairs in a way that caused me to win. And when I say win, there's just then an increase. There is an increase in the amount of equity in your company. There's an increase in the amount of assets that you keep in the business. There's an increase in the overall health of the business because of the decisions you made today. All right. You're being really kind to your future self in that respect. Okay. And the buck has to start somewhere. And I recommend it starts here and now with this understanding. Okay. And make those choices right now so that in the future you are set up to win. Guys, I'm hoping that you got some value out of this call. It's been great being with you. If you have any questions or comments, just leave them in the chat for me, guys, especially if you're chiming in from YouTube. Let me see more where YouTube people are at. Let's go. Fantastic. For my peoples on YouTube, just make sure you leave a message in the chat. We'll get back to you as soon as I can. I'll get back to you personally. Okay. Get back to you definitely before the end of the week. But guys, I'm hoping that you got some really tremendous value out of this that you can take on today make that choice, that line in the sand moment that I talked about, the choice that you get to make today moving forward to master your cash flow in this way, just by understanding how distributions impact you. Really cool thing. Like they're not taxable. You can extract money from your business. And you also want to understand, well, how much do I have in my business to extract, and what do I want my business to be like after I extract that distribution from it, so that it's continuing to rise and be healthy year after year after year. Okay, guys, it's been great being with you. Have a happy rest of your Monday, rest of your week, and I'll see you next Monday, same time. And if guys, man, Thanksgiving's coming up. Enjoy your holidays. Okay, enjoy your time with the family. All right, and we will see you next week. Take care.